At the start of this year, almost every expert agreed on one thing. Mortgage rates in 2026 were going to come down. Slowly, smoothly, predictably. They were wrong. In the span of about 4 months, rates dropped below 6% for the first time in years, and then did a complete U-turn, rocketing past 6.5%, wiping out tens of thousands of dollars in buying power for the average family. Almost nobody saw the reason coming. If you're thinking about buying a home right now, the next 10 minutes could save you from one of the most expensive mistakes of your life. So before you sign anything, watch this. Let's rewind to the beginning of 2026. After years of brutal interest rates, the housing market was finally supposed to heal. The forecasts were everywhere. Rates drifting down, buyers coming back, the spring season booming. Then in January, something dramatic happened. The federal government stepped directly into the mortgage market. The administration directed the two giant agencies that stand behind most U.S. home loans, Fannie Mae and Freddie Mac, to buy up to $200 billion worth of mortgage bonds. Your mortgage rate isn't really set by your bank. It's set by investors who buy bundles of home loans on the open market. When there's huge demand for those bundles, rates go down. $200 billion of forced buying is about as much demand as you can manufacture overnight. It worked, for a moment. By early February, the average 30-year mortgage rate dipped just under 6%, the first time it had touched the fives since late 2022. For buyers, this was electric. Suddenly, the math worked again. The same monthly budget could afford a home worth about $14,000 more than just weeks earlier. Within about 6 weeks, the magic wore off. And there were 3 quiet reasons why. First, the banks didn't fully pass the savings on. Even though the bond market loosened up, lenders kept most of the discount for themselves to protect their margins. Buyers saw maybe 0.1% of relief, not the full drop. Second, the government never explained how the $200 billion would actually be spent. No schedule, no rules, no clarity, and markets hate uncertainty. So they repriced everything higher to compensate for the confusion. And third, the deepest problem of all. Pumping cheap money into a market that's already starved for homes doesn't make houses more affordable. It just lets buyers bid more. Prices absorb the savings. You end up paying the same or more, just with a slightly lower rate stapled to it. So the Great Rate Rescue of early 2026, it lasted less than a single quarter. In late February, conflict in the Middle East erupted into open war, and one of the most important oil shipping routes on the planet was suddenly at risk. Now, you might be wondering, what on earth does a war overseas have to do with your mortgage in Ohio or Texas? It turns out, almost everything. Step 1, war threatens oil supply, so oil prices spike. Step 2, expensive oil makes everything cost more to produce and ship. That's inflation. Step 3, when inflation rises, bond investors demand higher returns to protect their money. So they dump long-term bonds, and the yield on the 10-year Treasury jumps. Step 4, U.S. mortgage rates follow the 10-year Treasury almost perfectly. It's the foundation lenders use to price every single home loan. The numbers tell the whole story. Right before the war, the 10-year Treasury sat at a comfortable 3.97%. Within weeks, it shot to 4.26%, then climbed to 4.47%, and mortgage rates tracked it almost exactly, from just under 6% all the way up past 6.5%, the highest level in about 9 months. Let me make that real for one person. A buyer in Minnesota was quoted 5.85% in February. A few weeks later, same bank, same buyer, the offer had jumped to 6.49%. That sounds small. It isn't. On a typical loan, that's about $265 more every month. Over the life of a 30-year mortgage, that one swing, caused by a war thousands of miles away, adds up to roughly $95,000 in extra interest for the exact same house. That's the moment the spring buying season froze. Buyers who were approved in February were suddenly disqualified by March, and the recovery everyone predicted? Gone. But wait, you might say, can't the Federal Reserve just cut rates and fix this? This is the trap most people fall into. And in 2026, the answer is no. And understanding why is the key to this whole video. The Fed got new leadership this year, under intense political pressure to slash rates and juice the economy. But the data won't let them. Inflation isn't cooling. It climbed to 3.8% in April, the highest in 3 years. The Fed's preferred inflation gauge is also creeping up. Meanwhile, economic growth is slowing. Economists have a word for that ugly combination: stagflation. Weak growth and stubborn inflation at the same time. It's the hardest possible situation for a central bank because the usual fix for one problem makes the other worse. And here's the cruel irony. Even if the Fed did cut its short-term rate to please the politicians, bond investors would likely panic that inflation is being ignored. They would sell off long-term bonds, which would push the 10-year Treasury up, which would push your mortgage rate up. The very thing meant to help could backfire. The takeaway is uncomfortable but important. The Fed has very little power to bring your mortgage rate down right now. The smart money is preparing for higher for longer. Mortgage rates stuck above 6% for the foreseeable future, with no rescue coming. If rates are high and buyers can't afford homes, shouldn't prices crash? Normally, yes. But in 2026, the usual rules are broken. The reason is something called the lock-in effect. Millions of homeowners refinanced or bought during the pandemic and locked in rates around 3 to 4%. If they sell and buy a new place today, they'd have to give up that 3% loan and take on a 6.5% one, potentially doubling their monthly payment for a similar house. So they're not moving. They're staying put, which means homes that would normally hit the market simply don't. The result is a frozen market. Very few homes for sale, so prices stay stubbornly high even as sales volume collapses. It's the worst of both worlds for a buyer. Expensive homes and expensive loans at the same time. By some measures, the price-to-income ratio is now worse than it was right before the 2008 housing crash. So this isn't a wait for prices to fall situation. If you're a buyer in this market, here are 5 things to look at very carefully before you sign anything. Number 1, run the rent versus buy math honestly. The old saying that renting is throwing money away isn't automatically true anymore. In a lot of cities, rents have actually been falling. The national median dipped to around $1,280. Meanwhile, owning costs are exploding. High interest, rising property taxes, and climbing insurance. In many markets today, renting and parking your savings in something safe yielding around 5% beats stretching into a 6.5% mortgage. Number 2, be skeptical of builder rate buy-downs. New construction companies are advertising amazing rates, sometimes under 5%. But that discount usually isn't free. Builders often bake the cost back into a higher home price and write contracts that favor themselves. Plus, new builds frequently come without blinds, appliances, or landscaping. Surprise costs of tens of thousands after closing. Get an independent buyer's agent. Think hard before taking an adjustable rate mortgage. ARMs are back, offering a lower rate for the first several years. But you're making a bet that rates will be lower in 7 years so you can refinance. If that bet is wrong, your payment can reset dramatically higher. In a sticky inflation world, that's a real risk. Watch for lender red flags. A rate that's too good to be true is often hidden behind sky-high fees, sneaky discount points, or a bloated cash-to-close number. Any last-minute change to your loan terms with no clear explanation is a major warning sign. Budget for the property tax reset. When you buy, the city often reassesses the home at your purchase price. This can spike next year's property taxes and balloon your monthly escrow payment, even if your interest rate never changes. So where do things stand today? There's a sliver of good news. In the first week of June, the average 30-year rate eased back to 6.48%, down from 6.53%. As easing energy fears took a little pressure off, the 15-year dropped to about 5.79%. A year ago, the 30-year mortgage rate was 6.85%. Today, it's 6.48%. On a $400,000 loan, that saves roughly $98 a month and about $35,000 over the life of the loan. That difference is enough to push some borrowers from denied to approved. But this market is defined by whiplash. Rates dipped under 6%, then surged past 6.5%, all driven by forces no buyer can predict. Government intervention, war, inflation. The ground can shift under you between your pre-approval and your closing date. Don't try to time the perfect rate. Nobody can. Don't wait for a price crash that the lock-in effect may keep frozen. Instead, buy only when the payment makes sense on its own. Stress tested against high taxes, high insurance, and no fantasy of refinancing later. In 2026, the buyers who win aren't the ones who guess the market. They're the ones who do the math, stay conservative, and refuse to get caught up in the panic. If this helped you see the housing market more clearly, hit subscribe. Because in a market this unpredictable, knowing what's really driving these rates is your biggest advantage. Drop your city in the comments, and I'll tell you what I'm seeing there. See you in the next one. Then a war broke out, and what happened next caught the entire housing market off guard. The real estate industry wasn't prepared for the sudden economic disruption. Property values shifted dramatically as investors reconsidered their strategies. Uncertainty gripped buyers and sellers across the nation. But amidst the chaos, patterns emerged for those paying attention. Understanding these market movements became crucial for any smart investor. The lessons learned from this period continue to shape housing decisions today.